Hello Susan, how are you today?
I am very well, Peter. How about you?
Yes, I am fine. Susan, we have discussed the risk of an ETF in the past. How do you calculate, and even more so, control the risk of an iBasket?
An ETF itself is diversified as it tracks a diversified index of an asset class or sub-asset class. For example, the FTSE 100 ETF has no idiosyncratic risk to any individual company in the index. A portfolio of ETFs is doubly diversified as it will benefit from the diversification into different asset and sub-asset classes.
And that's what you mean by controlling the risk of the portfolio.
Diversification helps in keeping the risk of a portfolio lower. But one needs to look at the risk properties of each ETF in the portfolio and how much the ETFs are correlated with each other in order to control the risk of the portfolio. A cautious portfolio, for example, will have a much higher allocation to low-risk assets. Depending on one's market view, one can add a tilt to riskier assets in order to aim for higher returns.
So for a cautious portfolio, I could have a high allocation to fixed income assets and cash of say 70%. And the remaining part can be in riskier assets.
The volatility of a portfolio of fixed weights can vary itself quite a lot over time. For example, if I have a portfolio of 60% in the FTSE 100 and 40% in gilts, the one-year volatility would have varied from less than 4% during quiet periods, but went up to 16.3% during the global financial crisis.
So you have to change your allocation over time in order to achieve a quite constant risk target of, let's say, 5% annually?
Yes. One looks at the correlations and the risk properties of the ETFs in the portfolio under the current market conditions and how it would behave over a longer time horizon and different market conditions. From that, one can infer what the current allocation should be and monitor the risk over time. By the way, the risk and correlation properties of the assets in a portfolio are called variances.
Is that why people talk about mean variance optimization? Wasn't Harry Markowitz who introduced it?
Yes. Mean variance optimization has developed further, but the basics are still the same. Calculate expected returns for the assets in your portfolio, calculate the variances, or risk and correlation, among the assets. Then determine your portfolio allocation by calculating the efficient frontier for a given risk level.
So depending on your views for each ETF and the current risk properties, you calculate the weights of the portfolio. I guess you then have to monitor that risk level over time and rebalance your portfolio accordingly?
Yes, exactly. One monitors not only the risk of the portfolio but also the view on each of the assets in the portfolio. When market conditions change, we rebalance the portfolio to constantly stay on the efficient frontier for a given risk level.
Thank you, Susan. I hope this will help to avoid the roller coaster behavior we have seen in some funds in the past.
We will definitely try our very best.